of 3. So let's go over the questions. Question 1, it's related to chapter 12. A big increase in government spending is an example of a demand shock, supply shock, demand shock, or supply or negative demand shock, negative supply shock. So if there is an increase in the spending, so that means if there is an increase in the budget, so it's not going to be a negative shock. So then we'll just need to decide whether it's a demand shock or a supply shock. So the government is not a company where it can produce products. So governments, they can have contracts with the private sector. So in that case, governments are on the demand side. So therefore, increasing their government spending will be a positive demand shock. Moving on to question 2. The yield curve spread between 10-year T-bond and the federal fund rate is what economic indicator? It is a leading economic indicator. So this is actually a knowledge so that every investor should be aware of. So people usually use the difference between 10-year yield and the federal fund rate, the difference between this to forecast the recession. So federal fund rate is a short-term rate, short-term bond yield. So 10-year bond yield is a long-term bond yield. So it's people's long-term expectation versus people's short-term expectation. So long-term expectation includes people's expectation towards economic growth, towards inflation, unemployment. And then short-term is basically the central bank interest rate, so which we call a federal fund rate. So if long-term wise, long-term minus short-term is a positive rate. So that means economy grow. There's some expectations for reasonable growth in the future. But if the difference is negative, so that means that there's too much uncertainty out there related to the economic growth. So there's a recession fears. So people rather to rather to pay less, or the interest rate is lower due to the recession concern that the 10-year bond yield is lower. So usually these rates, the difference is leading indicators that it shows up in the bond market before it shows up in the real economy. So next, the market value of all final goods and services produced during a given period is called GDP. So gross domestic product. Going down, which of the following would not be considered as a supply shock? A change in price of imported oil, forced damage to the orange crop. So imported oil is one of the raw materials that the industry use for producing stuffs. So all areas in this industry needs oil. So it's a supply. So it is a supply shock if there is a change in oil prices. So then it's not A. We're trying to figure out the ones that is not considered as a supply shock. And then the damage to the orange crop, so it's also a supply shock. It is damage to the agricultural produce. A change in the level of education of the average worker. Worker is human capital where we use to produce. So it's also a supply shock. So here, finally, an increase in the level of government spending. So we talk about in the first question that government spending is a demand shock. So D is not considered as supply shock. So moving on to question 5, the value of internet in companies is based primarily on current profit, A, Tobin's cube B, and C, growth opportunity, D, replacement cost. So in the class, we talk about replacement cost and Tobin's Q. They are all accounting-based measure, which measures the company's the value of company's assets. So if we want to replace all the company's assets now, so we pay the market price for replacing all the assets, and that will be the value of the market value of all the assets. So that is the idea of replacement cost. So we get an idea of the worth of the company's assets. So Tobin's Q is replacement cost divided by a denominator. So it's derivatives of replacement cost. So these two are related. So they are not the good measure for valuing internet companies. The reason is that internet companies, a lot of their value depending on their R&D or their softwares. So you don't need actual physical assets to produce a lot of them. So they are based on algorithm, based on the intellectual property of the software engineer. So human capital is one of the main thing, and then intangible assets like patents is another thing. Software, these are not that equivalent to the number of or the value of assets that the company owns. So therefore replacement costs in Tobin skills is not gonna be too appropriate for valuing internet firms. You can still use them to value internet companies, for example, how many chips that they have, how many data centers that they have. But it's not so it's not going to be primarily a primary measure. So I think when people look at internet companies, technology companies, they look at the growth potential. So for example, talking about a biotechnology company that they are invested into a couple of medicines that can deal with tackle some disease that potentially can open up the entire market and not only solve the human health problem, but also create great profit opportunities for the company. So open up the market share. And there's a potential huge demand out there. So the growth potentials is something that we are talking about and we care about for the technology company. And current profit, therefore, is the opposite side of growth potential. So if companies are doing their R&D innovations, they probably have more spending than profit. But it's at its current stage. The R&D is risky, but there's a chance that they can pay off in the future. So investing is about investing the current company as well as the company's potential in the future. So it's not just current profit. So moving down, a stock has an intrinsic value of 15 and an actual stock price of 13.5. You know that this stock's intrinsic value 15 and the actual price is 13.5. So which means that intrinsic value, the $15 is higher than the stock price 13.5. So its current stock price is under value. So under 15, under the actual intrinsic worth of the company. So therefore, what we know is A, the company has a Tobin's Q less than 1. That is not true. B will generate a positive alpha. That may be right. The reason is that so alpha is abnormal return. So if the current price of the stocks is correct, there shouldn't be any alpha. So there shouldn't be you invest into the stock and you should not get the price is fair. So it's a correct reflection of its intrinsic value. So in that case, the price should be priced at $15. But if you invest into the stock, it's priced at $13 and later on increase to 15, that means that the price currently is undervalued. So apart from the risk premium that you are being paid, you are being awarded with the abnormal return as well. Abnormal return, which is a positive alpha. So the model that we're talking about is the expected return equals to alpha plus beta times RM, market return. So beta is the risk exposure of the company. So the company may doing very risky, it measures the risk component of the company, its exposure to the market factor. So for example, if you are a pharmaceutical company, then even during market downturn, everybody's not doing great, recession, but the pharmaceutical company, they are relatively recession resistant because they are basically they are working on their own research, their own health research. So whether there is a recession doesn't really matter to them. They have their own way of raising capital based on the value of their the potential of their research. So so that means their beta will be low. If a company is on consumer discretionary, for example, Apple, for example, there are Target. So that means they are very sensitive to the consumer, the business cycle, the economic cycle. So their exposure to the economy is their systematic component is high. So B will be high. So so this is attached to the firm's characteristics. It's attached to how much systematic component that this company has. So when you invest into the company, you are also when we're talking about when you look at the risk characteristic of the company, you're looking at the beta. So so this part is fair. It will determine the fair price of the company if the company is currently not being mispriced. So if the company is being underpriced, the extra return will be offered by this part. So the A, which we call alpha. So extra return will not be coming from this part unless there is the error in estimating B. RM is the same for everyone. So there's no issue for RM. Shouldn't be any issue for RM if the company has abnormal extra, we're talking about extra return here. So if the market doing well, then everybody does well. If they have some systematic component, then we're not talking about extra. We're just talking about your exposure to the market. So therefore, if the company does better than the market, it's coming from the alpha term. So it's coming from the alpha term. And why does it, why would it do better than the market and people don't know at that time that in the future it's going to be, it will do better than we expected. So then that perhaps means that at that time with investors, they maybe ignore some signals or maybe there are some information that hasn't been incorporated into the company. So therefore, there's undervaluation at the beginning. So this which is not captured by B times the market return. So it goes to A. So that's in that case, the positive return, which is $15 minus 13.5 divided by 13.5, it's a positive return. Then that's going to represent a positive alpha. So there's another reason explaining why return is better than the market return. The other reasons will be that this model is wrong, that maybe there are other risk factors out there. For example, There could be a C risk factor, and there could be a D risk factor that can all explain the some specific type of systematic risk that the firm has. So, either the model is wrong, or the stocks was undervalued and was able to generate positive alpha. So this one is correct. And let's see others. Has an expected return less than its required return. So here, required return and expected returns are basically the same thing. It's like discount rate versus market capitalization rates. So we use it interchangeably. So then this is not relevant. And this statement is wrong. So next, has a beta greater than 1. So beta we explained. So in the model I just wrote. So beta is a systematic risk exposure. So it captures how much systematic components that the firm has. It's not related to, it's related to the company's risk profile, but it's not related to the company's whether the company is undervalued, overvalued is not directly related to the systematic risk that the company has. Okay, moving down, the company is expected to pay a dividend of 1.5, so in the coming year. So future dividend here, the risk-free rate is 6%. Expected return on the market portfolio is 14%. So the analysts expect the price to be 29 a year from now. The beta is 1.2 using capital asset pricing model, and appropriate required rate on the company stock is. So we're gonna use capital asset pricing model. So capital, we call it CAPM, capital asset pricing model, will give us this, the modeling of expected return of the stocks equals to the risk-free rate plus beta. So I'm gonna insert beta. This one. Insert. Times RM, expected return of RM. RM is the return on the market. So you can basically see it as S&P 500 return minus RF. All right. And what we have here is return equals to the risk-free rate, so just following the formula here, risk-free rate is 6% plus the beta 1.2 times market return 14% minus risk-free rate 6%, which is equals to 15.6%. So C here for this question. The company's stock return, expected return is 15.6%. All right, go down. Todd Mountain Development Corporation is expected to pay a dividend of $3 in the upcoming years. Dividends are expected to grow at a rate of 8%. The risk-free rate is 5. Expected return of market portfolio is 17. The stock has a beta equals to 0.75. Using the constant growth dividend discount model, the intrinsic value of the stocks is. So in this case, there are two steps. One is we need to figure out the discount rate, and we are using CAPM to figure out the discount rate. We're assuming the discount rate K equals to the expected return, and it equals to the risk-free rate, 5% plus beta times market return, 17% minus the risk-free rate, 5%. And the required rate of return or expect discount rate equals to 14%. And then we can use the dividend discount model, which is V equals to D1 divided by K minus G. So D1 is dividend in period 1. And here, I think the question says expected to pay the dividend of $3. So it's already, so the $3 is already the dividend in the future. $3 divided by 14% minus the growth rate, dividend growth rate is 8%. And that equals to $50. So the intrinsic value of the stocks is $50. So you're going to see that the key part is we're assuming that the dividend is growing at a constant rate, 8%. And this is a reflection of the company's future profitability, that it can sustain in paying dividend and then sustain a dividend growth of 8%. It basically tells you, hey, the growth of the company's profitability is 8%. So with that information, we translate it into the price of the company. It gives us $50. And also, given the discount rate is 14%, while this discount rate incorporates several information, it incorporates the company's risk level. So if the company is doing very risky businesses, which means that it could be, very volatile supply chain and very uncertain demand, uncertain supply. So in that sense, their risk could be very high. They could be very sensitive to economic cycle. So then, given that the expected return will be high, because the risk, the systematic component, the risk associated with this company is high. So if that, then it incorporated into this dividend discount model will basically means that a higher K related to a lower left-hand side value, a higher denominator. It's gonna, it means that there's a lower ratio. So then that's the only two features that is affecting the value of the company, the valuation of the company. One, it's its profitability, which is measured by the dividend growth rate. Another one, it's investors' cost of capital. So their required rate of return, which is 14% here. So the K here. So going down, ART has come out with a new and improved product. As a result, the company's projects ROE of 25%, and it will maintain a plowback ratio of 0.2. Its earnings this coming year will be $3 per share. Investor pays a 12% rate of return on the stock. At what price would you expect ART to sell? So in this case, we're still solving the intrinsic value where, there's an assumption there that the price equals to its intrinsic value equals to D1, using the same formula here. Now, we do have 12% as K being given already. And what we don't have is we don't have D1 directly, we don't have G directly. So here is the things that we talk about covered in the class. So G equals to ROE times the plowback ratio, B. So the growth of the dividend is basically the ROE growth rate. So yes, the return on equity, 25%, times how much capital is retained every year. So the plowback is 0.2, so basically means that the company will keep 20% of the profit and then paid 80% out every single quarter. So in this case, then the $20, so 20% will be reinvested into the next round of the project, and the 20% will be the base for generating this return on equity. So 20 is the equity, and the return on equity will be 25%. So it tells us the return, the growth rate. 25% times 0.2. And the dividend here, so because we have plowback, and we have earnings here, so dividend equals to earnings times plowback times 1 minus plowback. Plowback is how much the firm will keep for themselves. So 1 minus plowback will means that how much they will give out to the investors. And if they have $3 and plowback is 0.2, so that means they will be sending 1 minus 0.2 equals to 0.8 times 3, 2.4, $2.4. They will pay $2.4 for investors. Keep only 0.6, so 60 cents to the company themselves. So we got, let's see, so here 25 times 0.2 is 5. So we have 2.4 divided by 1.2, so 12% minus 0.5. So that equals to 2.4 divided by 0.07. That gives us $34.29. So $34.29, that will be the price, our expected price to pay for this stocks. So go down to the last question. So there is some company and the risk-free rate currently is 9%. Expected rate of return on the market portfolio is 19%. The company has a beta 2.5, and the company pays out 60% of its earnings in dividends. And the latest earnings announced was 20 per share. So its latest earnings announced. Okay, so move on. We need a couple of things here. So I think the dividend here will just pay, and we're expected to pay annually. So which means that we need to calculate future dividend. We were given the current dividend that was paid already. So we need to calculate future. And then the company was expected to earn an ROE equals to 25% per year on all reinvested earnings forever. So ultimately, I think when we are asked for the intrinsic value of the company, we will be using this formula here. And we just need to grab every piece of the information with so that we can plug in the number for this formula. So we currently don't have all of the information here. So we first need to figure out G. So I'm copying the formula up. I've explained it already. So ROE in this case is 25, and the plowback here is let me see. Yeah, the plowback here is here. The company pays out 60%. So when it said if it pays out 60%, so how much percent that they kept to themselves? It is 1 minus 60, which is 40%. So this is 0.4. Or yeah, so this will be 10%. And do we know D1 yet? We don't know D1, so we need to calculate D1 as well. So D1 equals to D0 times one plus G. So and D0, we need to get it from here. It's E0 times 1 minus plowback times 1 plus G. All right, so I got it from this. From D0 to this so we need to calculate D0 because we know but we don't know D0 directly from the question, but we know the earnings of the company and we know the plowback, so we can use the earnings and the plowback to calculate the dividend, which is just in one steps. And then we use the dividend growth rate to calculate the dividend in the future period. So E0 here, I think is $30. $30 times 1 minus 0.4 times 1 plus 0.1, the 10%, we got it from the steps. And that is $30 times 0.6, so 18 times 1.1 equals to 19.8. That will be D1. And then I think we have got D1, we have got G. How about K? So for getting K, I think we will need this formula. So the risk-free rate here is 9%. We are not given K directly, so we need to calculate ourselves. We know the beta, and we know the risk-free rate, we know the market return. So the market return is 19. So 19 here minus risk-free rate, 9%. And the beta here is 2.5. 2.5. And therefore, so 9% plus 2.5 times the difference between market return and the risk-free rate, that will give us 34%. Now we have everything we need. I'm just going to copy D1, 19.8 divided by 34% minus 10%. And that equals to $82.50. All right, so that is this question. Next, if the market price of the share is currently 81 and you expect the market price to be equal to intrinsic value 1 year from now. So currently, the price is 81. It does not equals to 82.5. So it's not fairly priced. It happened. So it's undervalued. Basically means that. So you expect the market price to be equal to the intrinsic value 1 year from now. So it will, so the price will change, the price of the company, the price of the share will change, and such that it will change in a way that it exactly equals the intrinsic value of the company 1 year from now. So you should notice that this V is V0, current intrinsic value. All right, so intrinsic value 1 year from now is V1, So future value. Calculate the price of the share after 1 year from now. So we want to know the price of the shares 1 year from now. This is the price, current price. Assume that it equals to this. But in our second questions, the price actually was 81. We want to solve for P1 one year from now, and we know that P1 equals to V1. So if we put it into a simple math expression, it looks like this. So the question looks like this. So currently P0 is 81, and then we expect in 1 year the price equals to intrinsic value in 1 year, and we want to know the price in 1 year. Now, we can based on this formula and calculate the intrinsic value. Equals to V0 times the growth. And that will be 82.5. There's no model here. We're just using the growth rate to calculate the growth of the company. The growth rate is the growth rate we are using for measuring the growth of the dividend. So the growth of dividend is 10%. And I think that's it. So you may wonder, how do we get this, right? We have V1, and then so if we, let me see, so this, if we change it to V1 here, this will be V2. K and G will be still the same. So then what is D2? So D2 is basically D1 times 1 plus G. Right? So effectively, this will be, the G will be the growth rate. Okay, so G will be the growth rate. So therefore, when we have V0 already, so we can just apply the growth rate, because the V0 has K minus G. So let me write it down. All right, so this will be this K minus G, and then equals to, let me rearrange it. And this part is V0. We got it here. So look at this. This is equals to V0. So here times this. So V1 equals to 1 plus G times V0. So it's $82.50 times 1 plus G, which is 10%, and that equals to 90.75. So $90.75. So that will be the price 1 year from now if we assume that the price 1 year from now equals to the intrinsic value. Then what is your expected 1 year period holding return? So the holding return are holding period return equals to dividend D1, the dividend received, plus the appreciation in price or depreciation in price times P1 minus P0, not times, plus. Divided by P0. So that equals to dividend 1, $19.8, plus P1, $90.75, minus P0, $82.50. That's the numerator, divided by P0. So that equals to 36.48%. Return is 36.48%, which is pretty nice. So that will be the questions for homework 3.